In 2003, Michael Markowski, a founder of both GFN Incorporated and StockDiagnostics.com, was named as one of the 50 great investors by Fortune magazine in their 2004 Investor Guide. Fortune said that StockDiagnostics.com's buy ratings on relatively unknown companies had generated returns of 80% for institutional investors during 2003. Fortune went on to say that Markowski's secret to success in finding undervalued stocks is that he analyzes a company's cash flow. Markowski told Fortune, "Cash flow is a good indicator when a struggling business is about to turn positive." WebEx, which was Markowski's stock pick for the article, appreciated by 200% from the price that he recommended it to when it was acquired by Cisco Systems. In that same year that Markowski was named by Fortune as one of the 50 great investors, he embarked on a quest to use the cash flow metrics that he monitors to find the most exceptionally undervalued low-price stocks, those that had the potential to multiply in price. To find them, he started with a list of the 100 that had the best cash flow metrics. After researching the financial statements of all of them, he narrowed the list to 2 companies which were the most exceptionally undervalued when compared to the remaining 98. The 2 companies that Markowski found were TRM Corp and Invest Tools. The share price of both were under $1. Markowski gave the 2-penny stock recommendations that he discovered to several investors. One of them was a shareholder who implicitly followed Markowski's instructions as to when to sell them. He purchased TRMM at 85 cents per share and sold it 14 months later at $18.44 per share for a return of 21 times, or $210,000 on each $10,000 invested. He also purchased IEDU at 24 cents per share and sold it 48 months later at $12.14 per share for a return of 50 times, or $500,000 on each $10,000 invested. The main reason why Markowski was able to find 2 companies with share prices that multiplied more than 20 times is that he discovered both companies had a rare anomaly. Both companies had free cash yields in excess of 50%. Let's put a 50% free cash yield into perspective. In simple terms, it would be like buying a $100,000 building that throws off $50,000 net rental income per year. Would you be willing to pay $100,000 for an apartment building which provided annual rental income of $50,000 after all taxes and maintenance expenses were paid? That's a no-brainer. How does such an opportunity happen? There are rare instances when a perfectly healthy company reports a significant paper loss on their income statement that does not affect the operating cash flow or the company's operating health. The reporting of these losses almost always causes a wholesale sell-off of the stock by the uninformed public. Those shareholders who are aware that it's just a paper loss know not to sell at all-time lows. However, the public panics and sells at the bottom because they believe the company is going out of business due to its reporting of a large loss. On rare occasions, this drives the stock value to a point where free cash flow represents more than 50% of the price. Invest Tools was one of those rare occasions in 2003. With a share price of 17 cents, had a free cash flow yield of 65.9%. At the same time, TRM Corporation was yielding over 100% free cash flow at 64 cents per share when it was discovered by Michael Markowski. Companies that have share prices below a few dollars and are generating free cash yield in excess of 50% per share with solid balance sheets are extremely rare and are very hard to find. Finding them would be like finding a Rembrandt at a garage sale. Both of these companies represent very rare accounting anomalies where the negative earnings reports contradict the actual progress of the company. The shares of these 2003 companies did not remain at low prices very long. The shares of both companies increased by more than 100% within the first 90 days after they were discovered by Markowski. The shares of Invest Tools didn't stay down very long. It was originally 17 cents a share when the 2003 study identified it. The next quarter, it went up 4 times in value to 74 cents per share, and within a year, it was up 12 times its value to $2.17 per share. TRMM shares practically doubled over each of the first 4 quarters after Markowski discovered it at 64 cents per share. It closed at $1 at the end of that quarter, and the following 4 quarters went to $1.85, $4.05, $8.53, and then to $17.94. The key to buying these very rare accounting anomalies is to get them when they are incredibly cheap, but they don't remain cheap very long.